I think I'd give Corporate Australia a pass mark. It was actually quite a good reporting season across a range of factors, but it was very, very varied across the different elements of the market. So we saw more companies actually doing a little bit better than most people thought they would do, as opposed to companies that did a little bit worse. The quality of results was very, very high, and when I mean quality, we look at cash generation and margins and the cleanliness of results. And what was really pleasing was that the outlook for 2018 growth was actually maintained and actually slightly lifted. So that's very, very different to the last 5 years where we've seen more downgrades as opposed to upgrades going out a year. Look, there was some really material differences across a range of sectors, and it actually built off a number of key themes that we're seeing. So given what happened in China during the year in terms of stimulating their market and intervening in commodity markets, it drove Australia's largest two commodities materially higher, iron ore and coking coal. So the resource sector had a very, very strong reporting season. What was interesting about that though is over the year expectations for these companies had actually risen quite materially as well. So after they delivered exceptional results, a lot of these companies have sold off quite materially. Excluding the resources sector, if we draw that to the side, revenue growth in Australia is only about 3%. So it's quite low, inflation plus a bit. It's really consistent with what we've seen the last couple of years. So we're in a real grind if you move outside some of those cyclical sectors. Pleasingly, executive teams are not being overly optimistic in terms of reaching too far, and they're focusing on reducing costs, generating cash flow and providing balance sheet flexibility to reward shareholders. It's exactly what they should be doing at this in a low growth environment. And so what that means is we're seeing good amounts of dividends paid out, high payout ratios at the moment because there's not a lot of growth options to invest in. Another thing that we think is going to kick in the coming 12 months, we're seeing early signs of it now, is corporate activity. So companies acquiring companies, hopefully at the right price and extracting a range of synergies and looking at that as another avenue to drive growth. And they've certainly got the balance sheets to be able to do that. And I think the last thing is the outlooks were quite varied. The right sectors went okay, so if I was going to be at the more positive end of the spectrum, it would be the resource companies, given commodity prices are still reasonably high. Look, the healthcare companies have all got really strong, solid fundamental drivers and are quite optimistic about the future for growth. And infrastructure companies, which particularly companies like Transurban, Sydney airports, where they've not only got inflation-protected growth within their current business models, they've got opportunities to deploy more capital. If I was going to the other end of the spectrum about where it was a little bit more cautious, certainly in the housing space is where we've seen a material change in the last 12 months. So whether you look at companies like Real Estate.com, where listing volumes are down, or some of the lenders mortgage insurance companies like Genworth, or just the banks in general, reporting lower levels of growth in that part of the market. We've had an exceptionally strong property market for a number of years, and it feels like, and supported by these comments, we're in the latter part of that cycle. Look, there were a couple of surprises that caught the market off guard during reporting season in the bigger end of town. So a couple of names that really had quite poor results and sold off quite aggressively were Brambles and Telstra. Okay, so two well-known blue chip companies in Australia. We've been in a very macro-driven market for a while, and what reporting season gives us the opportunity to do is to focus on company fundamentals again and remind us of the quality of businesses that we're invested in or is exposed to in the Australian index. Brambles had been bid up on the back of the global reflation trade and improving macro environment. Well, it certainly didn't happen and the shares were actually quite weak. Telstra, which would be in a lot of people's portfolios, and it's a company we've been talking about for some time as to beware, has been in an increasingly competitive environment. So they did a great deal with NBN, with the government, but what that's really done is it's focused competition on one of their key growth areas being broadband and mobiles, and that's really come home to roost in these results. So they've been some material underperformers. Where we got some positive surprises, resources to a degree, but it was largely expected. Really across the healthcare names, we've had quite a few large healthcare names report very, very strong results. We've also had some exceptionally good results in the infrastructure sector and across a broader range of diversified financials. So quite dispersed, but a couple of key positive sectors there. look, pleasingly the portfolio navigated the reporting season really, really well. We've had quite a few companies that we own in the portfolio that had very, very strong results. You know, Woolworths, as I mentioned, you know, Transurban had an exceptional result, CSL and ResMed, getting down into companies like Green Cross, and car sales, and a company we've held in the portfolio for a long time that we think has a great outlook is Challenger Financial Services. The growth in annuities in Australia is absolutely booming at the moment and likely to get a lot bigger. So they went very, very well. But just as importantly was avoiding the pitfalls. So not having any Brambles in the portfolio, not having any Telstra in the portfolio were a big help. And also, we don't hold any listed property trusts in the portfolio, and they've really started to roll over in the last 6 to 9 months because the outlook for interest rates is starting to rise, and they're bond proxies, and they don't have any growth outside of not a lot of growth outside of that, so they get sold off pretty heavily in that type of environment. So really pleased with how the portfolio went. We outperformed the market during the month. What we've seen is a more encouraging backdrop develop over the last 12 to 18 months. With Donald Trump in presidency in the US, has got a pro-growth agenda. We've had China actively move to stimulate its economy. We've got continuing evidence that the banking system in Europe is holding up really well, despite all the challenges that they've got there. And look, domestically here, we're sort of bumbling along okay, but we're getting a bit of a free kick in our resources part of the market at the moment. So we're more optimistic about the outlook for growth, which is a good thing. Interest rates are definitely going to move up, and that has to be taken into account in people's portfolios, because a lot of the stars that were, from 2011 to 2015 that were beneficiaries off the back of interest rates going lower and lower and lower, it's going to start to reverse. And we're already seeing good signs of that starting to reverse now. But what we have seen is a material move up in risk asset classes and the valuations of risk asset classes. So looking at equities, picking the S&P 500, the US index, it's trading well above its long run average in terms of earnings multiples. So it's pricing in a good degree of future growth. So while we're more optimistic about the growth outlook and what that may offer in the future, we think a reasonable amount of that is actually starting to be priced into markets. So what that means is we're not going to be at the upper end of our risk allocations for things like equities in this environment. And in fact, given volatility is so low around in markets globally, it's at its lowest all-time level, despite the fact we've still got a number of uncertain events yet to play out around interest rates, around geopolitical events. We're actually pretty happy to sit on a bit of cash at the moment. So over the back half of last year, we built a bit of cash in the portfolios, and that's because we think volatility is going to pick up. And the reason we build cash, and it's not earning a great return in cash at the moment given where rates are, is because we want to be buying things on sale. So that's what volatility allows us as active fund managers to be able to do. Really what happened is we saw two very, very different years in terms of risk markets or equity markets in 2015 and 2016. 2015 saw a very big sell-off in markets, and 2016 saw a very big rally in markets. If you look at it over the 2 years, as we put here on the ASX 200, it's actually up about 5% over that 2-year period. What you can see from our portfolio is as markets declined quite aggressively in 2015, we preserved capital. We actually had a slight positive performance over that period of time, and then returns have flattened off. And we didn't share in the rally that occurred in 2016, which really comes down to two things: how we manage risk in the portfolio and the types of assets that rallied very, very hard. So we always have a reasonable element of our portfolio in diversified assets such as alternatives, which are not going to be as impacted by strong equity market rallies, and it will be a reason why in very, very strong market rallies we will likely lag those overall returns. But I think you can see in 2015 around preserving capital, when diversification traits really come to the fore of managing portfolios and assisting us to achieve our objectives. So we're really confident. 2016 we don't think is going to be, the primary drivers are going to be the same going into 2017. We think that was quite an exceptional year where things like the materials index are up 70% and things like healthcare are just slightly negative, or infrastructure is flat. We think that's sort of behind us given those sharp price moves, and we're really confident about achieving our portfolio objectives over coming years.